Us now, Citi Private Wealth Chief Investment Strategist Stephen Wieting. Stephen, thank you for being here. What do you make of today's market action, and how do you think it positions the market for 2025?
Well, I think for a little bit of perspective for everyone, prior to this morning, the S&P 500 was up 25% for the year on what's going to turn out to be about a 10% earnings gain. So everyone just recognizing that around 6,000 for the S&P 500 is a pretty full level. We've had 2 good years here after a really bad one. The economy is going to grow. We have been through a period of just reconciling that the Federal Reserve is not going through some radical easing and we don't have a growth paradise. We have a good deal of policy uncertainty. But if we continue to have an outlook for economic growth through 2025, that there's more to come, I think that we will, in fact, have a decent year. But it's not going to be on the path that we've just had, which, over the 2-year period was a 54% gain after the losses of 2022.
Yeah, it's been a remarkable 2-year period. So then should investors diversify away from the S&P 500? And if so, where should they diversify? We were talking last hour about the fact that U.S. exceptionalism, and particularly some of the big tech names, have been the beneficiaries of a lot of flows over the last few years, which has helped drive them higher. Where else should investors diversify, if not for the S&P 500?
Right. Well, look, 30 times earnings, 20% EPS growth, seems to be like we should still have a position in U.S. large cap tech. That is where there's going to be a great deal of future innovation, but heavily priced. So you really have to zoom out to what you just addressed. It's been 15 years of U.S. outperformance, about 20% in the latest 12 months, which is big. But the 15-year mark is what I really focus in on. And so the rest of the world has been left in the dust. It's outside the United States. The world share markets are 1/3 of global equity market cap. And there's no real visible catalysts for why that should change. But if you do expect that the world economy is going to strengthen from some of the declines that you just saw in the Chicago PMI, for example, the manufacturing sector across the world is still yet to really get to its feet, you'll probably see broader gains. And if you think about how the premium on U.S. shares has picked up over 15 years' time, I think that you're going to see that the S&P 500 is not going to be the best performing asset class for 10 years. I mean, after all, we've got a 13% return for 10 years, through 2 very different administrations and a new one coming. So I'd also look at alternatives, that if you think about some of the fixed income markets that can offer yields, just give you one in public markets. The loan market is probably going to return close to 8%, over the next 12 months. I wouldn't substitute stocks for that. I don't take that as an alternative to U.S. Treasuries, but as a yield enhancer and a diversifier with very low volatility, probably quite solid credit. This is an opportunity that we would add to portfolios because you won't want a portfolio that just looks like the S&P 500 for the coming decade.
Yeah, that pitch has definitely helped spur tremendous growth in that sector over the last few years as well. Invesco Global Market Strategist Christina Hooper also joining us today. Do you think the market kind of honing in on technology, do you think it was discriminating enough when it comes to AI this year? Do you think that anything that was just even AI adjacent went up? And what do you think that tells you about 2025?
Well, I don't think it was discriminating enough, but that's the nature of something that is so groundbreaking and innovative. You tend to see that all AI adjacent, anything related tends to rise. I mean, we saw that with .com stocks in the 1990s. And it's just a normal part of the process. And then we do see greater discernment as time moves on. And as we realize where the greatest beneficiaries are and what the most compelling plays are. But I think it's just natural. It's human nature to, when there is something that is so different and just has the potential to be transformative, that we would see just this sort of mass move into anything that relates to it.
Christina, what's your snapshot take of the economy we have right now going into next year? I ask because you look at Atlanta Fed GDP tracking, it's like near 3% real growth. And yet some of the numbers that have been coming in, the labor market has softened up. Obviously, manufacturing has not really come off the mat. And you have housing related activity also, kind of retreating a little bit here. So what's your thought in terms of the growth trajectory into next year?
So this is an economy that is slowing and cracks are clearly forming. It's been more resilient than we expected, I think, than markets expected, but there are clearly cracks forming. We just saw credit card issues, greatest number of defaults since 2010. There are a lot of issues in particular areas of the economy. But the overall economy has been chugging along. What I think we're going to see is a lot of excitement that then becomes something of a reality. We're going to see, the deregulation begin quite quickly. I think that's going to be impactful, and I think that's going to unleash animal spirit. So I think we're going to have a relatively strong economy in 2025. I think we could see some slowing in the near term, but I think we'll see a reacceleration. And it's not going to be just the U.S. I think there's potential for the Chinese economy to rebound. And I think major economies then bring along other economies with it. So I'm quite positive on the global outlook for 2025.